On a damp morning in 1602, a small crowd gathered inside a vaulted hall near Amsterdam's Dam Square. The air carried the smell of wax and wet wool. Merchants in dark cloaks leaned over rough wooden tables, while clerks bent to their ledgers. Sheets of parchment changed hands. Names were signed with deliberate strokes. Money was counted, tallied, and acknowledged. Outside, ships prepared to leave for Asia. Hulking vessels bound for Bantam and the Moluccas, their hulls packed with silver and their futures dependent on winds half a world away. Inside that hull, however, something quieter was taking shape. The claims to those voyages, the right to share in their profits, were being divided, sold, and resold among people who would never step on deck. Ownership itself had begun to move independently of ships and spices. It was not a riot. It was not a revolution. It was the early trading of shares in the Dutch East India Company. For generations before that morning, long-distance trade had depended on tight circles of wealth. A single voyage to Asia required vast capital, ships, crews, armaments, provisions for years at sea. In 15th and 16th century Europe, such ventures were typically financed one journey at a time. Investors would pool funds for a specific expedition, wait years for its return, and then divide the proceeds, if the ships survived storms, disease, or Portuguese cannon fire. The structure was temporary. Capital was tied up for long periods. Risk was concentrated. If a voyage failed, fortunes could vanish entirely. As European trade expanded, the limitations of this system grew sharper. The Portuguese Estado de India operated under royal control, but maintaining fortified posts from Goa to Malacca strained even a monarchy's treasury. Private merchants elsewhere lacked the ability to sustain continuous fleets in Asia. Competition intensified. Profits were high, but so were losses. The Dutch Republic, newly independent from Spain, faced a practical problem at the turn of the 17th century. Multiple small Dutch trading companies were competing against one another in Asia, driving up costs and weakening their bargaining position. At the same time, the scale of trade demanded more stable financing than short-term partnerships could provide. In 1602, the States General of the Dutch Republic merged these rival firms into a single chartered enterprise, the Verenigd Oost-Indisch Company, the VOC. The charter granted the company a 21-year monopoly over Dutch trade east of the Cape of Good Hope. It could build forts, sign treaties, wage war, and mint coins. Yet its most durable innovation was financial rather than military. Instead of financing a single voyage, the VOC raised capital for an ongoing enterprise. Subscriptions were open to the public across several Dutch cities. Individuals could invest sums large or modest. Once committed, their capital remained with the company. In return, they received shares representing proportional ownership in a permanent joint stock corporation. The money would not be returned after one voyage. It would remain in the enterprise, funding fleets year after year. Profits, when declared, would be distributed as dividends. This subtle shift altered the rhythm of trade. Capital no longer dissolved at the end of each expedition. It accumulated. Ships could be built in succession. Warehouses established. Permanent bases secured in Batavia. The company could think in decades rather than seasons. But another development followed, almost naturally. Investors who had subscribed to the VOC soon discovered they were not locked into their positions. If they needed liquidity, they could sell their shares to someone else. Amsterdam's merchants began meeting informally to negotiate these transfers. Over time, these gatherings coalesced into a more regular marketplace near the city's Damrak district. By the 1610s, a secondary market for shares had emerged. Buyers and sellers agreed on prices reflecting news from Asia, rumors of shipwrecks, or expectations of future dividends. The Amsterdam Exchange, housed in a purpose-built structure completed in 1611, became the place where such transactions were recorded. No cargo was present in the hall. No spices changed hands. Only claims did. This was the crucial departure. The original investors had supplied capital to a trading company. The exchange allowed that capital stake to be transferred without disturbing the underlying enterprise. Ownership became divisible, standardized, and mobile. A merchant in Haarlem could sell part of his interest to a brewer in Leiden. A widow in Amsterdam could purchase shares as a source of income. Risk, once concentrated among a handful of wealthy financiers, spread across hundreds and eventually thousands of participants. The mechanism was neither mystical nor abstract. It relied on ledgers, not theory. Shares were recorded in company books. Transfers required registration. Prices were negotiated in person. Dividends were paid in cash or, at times, in kind, sometimes even in spices themselves. The exchange did not create goods. It created a venue where financial claims could circulate. That circulation mattered. As shares traded more frequently, their prices conveyed information. A rising share price signaled confidence in future profits. A decline reflected setbacks or heightened risk. Investors responded accordingly. Capital flowed toward enterprises perceived as capable and away from those that faltered. The system rewarded scale. Because ownership could be divided into small units, large sums could be assembled from many contributors. The VOC's initial capital, over 6 million guilders, was unprecedented for its time. It exceeded the annual revenues of many European states. Other ventures took note. Insurance contracts for maritime trade developed alongside share trading, spreading risk further. The Bank of Amsterdam, founded in 1609, stabilized currency and facilitated large payments. Financial infrastructure clustered together, reinforcing one another. What began as a solution to the financing of Asian voyages evolved into a broader architecture of capital. Power shifted in subtle ways. Trade patterns adjusted as well. The Dutch Republic, though small in territory, became a central node in global commerce. Its fleets dominated the Baltic grain trade and Asian spice routes alike. Amsterdam's ports swelled with ships. Warehouses lined its canals. The ability to mobilize large pools of capital allowed Dutch merchants to underprice competitors, sustain military outposts overseas, and endure temporary losses in pursuit of long-term dominance. The VOC was not merely a trading firm. It functioned as a quasi-sovereign power in Asia. Yet its authority rested on a financial base organized at home through share ownership. Influence no longer depended solely on royal treasuries or aristocratic fortunes. It could be assembled from urban investors seeking returns. The model did not remain confined to the Netherlands. In 1698, the London Stock Exchange began taking shape in the coffeehouses of Change Alley. The English East India Company, chartered earlier in 1600, adopted and refined joint stock principles over time. By the 18th century, government bonds, bank shares, and canal companies were actively traded in London. The pattern repeated: permanent capital, transferable shares, organized markets. This did not eliminate risk. Speculation surged periodically. The South Sea bubble of 1720 revealed how enthusiasm could detach from underlying value. Yet even that episode demonstrated how deeply the stock mechanism had penetrated British finance. Shares in distant enterprises could command the attention of an entire nation. Over the long term, the joint stock exchange proved adaptable. During the Industrial Revolution, railways required immense upfront investment. Factories demanded machinery, land, and labor on a scale beyond individual fortunes. Public share offerings allowed these enterprises to raise funds from thousands of investors. The exchange provided liquidity, encouraging participation. Modern corporations inherited this structure. Shares represent fractional ownership. Boards of directors oversee management on behalf of dispersed shareholders. Profits are distributed as dividends or retained for reinvestment. Stock exchanges, electronic now rather than confined to stone halls, facilitate continuous trading. The DNA remains visible. Permanent capital pools, transferable ownership, organized markets where price reflects expectation. Yet it would be imprecise to say that the first stock exchange created modern capitalism in a single moment. Market economies, private property, and trade networks predated Amsterdam by centuries. Italian city-states had experimented with transferable debt instruments. Medieval fairs linked distant regions. What Amsterdam's exchange did was standardize and scale a particular mechanism: the separation of enterprise from individual investor, and the separation of ownership from physical possession. A ship could be in Java while its ownership changed hands in Europe. That abstraction, grounded in meticulous record-keeping, allowed capital to become fluid. Enterprises no longer depended entirely on the lifespan or wealth of a founder. They could persist, expand, and outlive individuals. By the 18th century, this financial structure supported colonial ventures, infrastructure projects, and state borrowing on an unprecedented scale. By the 19th, it underpinned industrial expansion. By the 20th, it shaped multinational corporations whose operations spanned continents. Each evolution built upon the ability to divide, transfer, and price ownership claims. Back in Amsterdam, the exchange building itself became a symbol of the Republic's commercial order. Merchants met beneath its arches at fixed hours. Contracts were enforced by reputation as much as by law. Information traveled along shipping routes and through letters carried across Europe. The scene was orderly, measured. Clerks with ink-stained fingers recorded transactions in careful script. Prices were called out. Agreements were sealed with a handshake. Outside, ships still departed for Asia, their sails heavy with wind. Inside, ownership shifted quietly from one ledger to another. The hulls would age and rot. Forts would fall. Empires would rise and recede. But the practice that began in that hall, the buying and selling of standardized shares in a permanent enterprise, would endure, adapting to telegraphs, ticker tape, and digital screens. In 1611, when the Amsterdam Exchange opened its doors in a purpose-built structure, it did not announce the birth of a new economic order. It offered a covered place where merchants could meet out of the rain. Under its roof, however, claims to distant voyages changed hands with increasing regularity. Ink dried on paper. Prices were agreed. Ownership moved without cargo. The sound was not the crash of cannon or the creak of timber at sea. It was the steady turning of pages in a ledger, as modern capital learned how to circulate. If this gave you a new perspective, hit subscribe. History has the answers. I'll show you where to look.